Financial markets include various platforms where financial instruments like stocks, bonds, commodities, and currencies are traded. The performance of these markets is typically measured using a variety of metrics and indicators, such as stock market indices. Indices like the S&P 500, Dow Jones Industrial Average, NASDAQ, and others track the performance of a group of stocks, representing the overall market or specific sectors. These indices reflect the aggregate performance of the companies within them. Bond yields, commodity prices, exchange rates, volatility indices, example, VIX, interest rates, economic indicators, investor sentiment. Financial markets in the U.S. tend to exhibit distinct patterns during presidential election years. The relationship between elections and market performance is driven by the uncertainty that elections introduce and the potential policy changes that could follow. Here's how markets typically behave during these periods. 1. Pre-election year. Historical trends. The year before a presidential election is often strong for the stock market. Investors tend to anticipate a stable political environment, which can boost market confidence. Market drivers. Incumbents often pursue policies to boost the economy and market sentiment to improve re-election prospects. This can result in favorable market conditions. 2. Election year. First half of the year. Volatility. Markets can be more volatile due to uncertainty about the election outcome. Investors may be uncertain about the future direction of fiscal, tax, and regulatory policies. Caution. Investors may adopt a more cautious approach, potentially leading to sideways or slightly negative market movement. Second half of the year. Clarification of outcomes. As the election date approaches and polling data becomes clearer, markets may stabilize. Historically, markets often perform better in the second half of the year as uncertainty begins to diminish. Post-election bounce. Once the election outcome is known, markets often experience a relief rally, especially if the result aligns with investor expectations. 3. Post-election year. First year of new presidency. Market reaction. The market's performance in the year following the election can be mixed and largely depends on the new president's policies and their perceived impact on the economy. Presidential cycle theory. This theory suggests that the first year of a presidency might see weaker performance as new policies are implemented, often leading to some market disruptions. 4. Midterm year. Second year of presidency. Historical weakness. The second year of a presidency often sees weaker market performance, especially in the first half. This is typically due to policy adjustments and the midterm election uncertainties. 5. Impact of party control. Republican versus Democratic presidents. Historically, the market has performed slightly better under Democratic presidents, though this varies widely depending on the specific policies and economic context. Unified versus divided government. Markets tend to favor a divided government. One party controls the presidency, and another controls Congress, because it limits the potential for extreme policy changes. 6. Sector-specific impact. Different sectors react differently depending on the policies likely to be implemented by the winning candidate. For instance, healthcare can be highly sensitive to election outcomes, especially with potential reforms on the table. Energy. Policies on climate change and energy independence can lead to volatility in this sector. Defense. Defense stocks may respond positively to candidates favoring increased military spending. 7. Case study examples. 1980 election. Ronald Reagan versus Jimmy Carter. Background. The 1980 election occurred during a period of high inflation, economic stagnation, stagflation, and geopolitical tensions. Example: the Iran hostage crisis. Market performance. Pre-election. The stock market was volatile, reflecting economic uncertainty and the public's dissatisfaction with President Carter's handling of the economy. Post-election. After Reagan's victory, the market experienced a rally, as his pro-business policies, including tax cuts and deregulation, were well received by investors. The S&P 500 rose by approximately 25% over the following year. Key takeaway: Reagan's win marked a shift towards conservative economic policies, which boosted market confidence and led to a sustained bull market in the early 1980s. 1992 election, Bill Clinton versus George H.W. Bush. Background: the 1992 election came after a mild recession and during a period of sluggish economic growth. George H.W. Bush's popularity had waned despite his leadership during the Gulf War. Market performance: pre-election, the market was relatively flat leading up to the election, reflecting uncertainty about the direction of economic policy. Post-election, Clinton's victory initially led to some market jitters due to concerns about potential tax increases. However, the market soon rebounded, as Clinton's policies on fiscal responsibility and economic growth, including NAFTA, were well received. The S&P 500 gained about 7% in the year following the election. Key takeaway: despite initial concerns, Clinton's centrist economic policies reassured markets, leading to a robust economic expansion and strong stock market performance in the 1990s. 2000 election, George W. Bush versus Al Gore. Background: the 2000 election was highly contentious and ended in a legal battle over the vote recount in Florida, creating significant uncertainty. This election also coincided with the bursting of the dot-com bubble. Market performance: pre-election, the market was already under pressure due to the tech bubble burst, with the NASDAQ having fallen sharply from its peak earlier in the year. Post-election, the uncertainty following the contested election result led to increased market volatility. The S&P 500 declined by about 9% between Election Day and the Supreme Court's decision to halt the Florida recount, which effectively decided the election in Bush's favor. Following year, the market continued to struggle as the recession deepened, exacerbated by the September 11th attacks in 2001. Key takeaway: prolonged electoral uncertainty can have a negative impact on market performance, especially when combined with other economic challenges, such as the bursting of a speculative bubble. 2008 election, Barack Obama versus John McCain. Background: the 2008 election occurred during the global financial crisis, with markets in turmoil following the collapse of Lehman Brothers and the subsequent credit crunch. Market performance: pre-election, the S&P 500 was extremely volatile, losing significant value as the crisis unfolded. Post-election, markets initially fell further after Obama's victory, reflecting ongoing concerns about the depth of the financial crisis. However, as the new administration's plans for economic recovery, including the stimulus package, became clearer, the markets began to stabilize. Following year, the S&P 500 bottomed in March 2009 and then began a strong recovery, driven by the fiscal stimulus and monetary easing policies implemented by the Obama administration and the Federal Reserve. Key takeaway: major economic crises can overshadow electoral outcomes, but clear and decisive policy responses, example, stimulus, bailouts, can eventually restore market confidence. 2016 election, Donald Trump versus Hillary Clinton. Background: the 2016 election was marked by significant political polarization and uncertainty, with Trump's candidacy seen as highly unconventional and unpredictable by many investors. Market performance: pre-election, markets were volatile, with concerns about what a Trump presidency might mean for trade, immigration, and regulation. Polls suggested a Clinton victory, which was generally seen as the more predictable outcome. Election night, futures markets plummeted when it became clear that Trump would win, with Dow futures dropping nearly 800 points overnight. Post-election, contrary to the initial reaction, markets rebounded sharply the next day, driven by optimism about Trump's promises of tax cuts, deregulation, and infrastructure spending. The S&P 500 ended 2016 up by 11%. Following year, the market continued to perform well in 2017, with the S&P 500 gaining around 19% as corporate tax cuts were passed and economic growth accelerated. Key takeaway: unexpected electoral outcomes can lead to short-term volatility, but markets may recover quickly if the incoming administration's policies are perceived as business-friendly. 2020 election, Joe Biden versus Donald Trump background. The 2020 election took place during the COVID-19 pandemic, which had led to severe economic disruptions and unprecedented market volatility earlier in the year. Market performance. Pre-election, markets were highly volatile, influenced by pandemic developments and concerns about the election's legitimacy, particularly given Trump's rhetoric about potential voter fraud. Post-election, despite fears of a contested election, markets responded positively once it became clear that Biden had won, with the S&P 500 rising by about 10% from election day to the end of the year. This was supported by optimism about vaccine developments and expectations of continued fiscal stimulus. Following year, the market continued to rise in 2021, bolstered by massive fiscal stimulus, low interest rates, and the rollout of COVID-19 vaccines. Key takeaway: even in the face of significant uncertainty, markets can perform well if the underlying economic policies are supportive and if major risks, like the pandemic, show signs of being mitigated. These examples demonstrate that while U.S. presidential elections can introduce volatility and uncertainty, markets typically adapt quickly once outcomes are clear and policy directions are understood. The broader economic context, such as prevailing economic conditions or crises, often plays a more significant role in determining market performance than the election itself. Understanding these dynamics can help investors navigate election years with greater confidence. Thank you for joining us. We hope you found the information valuable and empowering. Don't forget to like, share, and subscribe to our channel for more insightful videos on personal finance, investing, and retirement planning.